12.25. Yes. So this one is giving you 12.25. So expected return is what was given. Check in the question. Are you able to see expected return for A? Tomato and apple? 10. So we take 10. Now we minus this one, which is 12.25. So we get a figure of negative 2.25. So when it is negative, it means it is inefficient. When it is negative, it is inefficient or overvalued. So the comment, it is inefficient or overvalued. So the comment there we indicate it is inefficient or overvalued. Inefficient or overvalued. So remember, this is the market. Security market line is the benchmark or the market. Then you have seen that this market is giving you 12.25, but the security will give you 10. So it is inefficient or overvalued by the market forces. So first we calculate for all of them, then we comment whether to change the composition or not to change. So that is now for stock A. So stock A, it is inefficient or overvalued because it is giving you less return than the market. It is giving you less return than the market, and because of that, it is inefficient or it is overvalued by the market. So we go to stock B. We go to stock B. We go to stock B. So for stock B, correlation coefficient is also given as negative 0.75. Negative 0.75. Then the standard deviation was given as 20. Multiplied by 20, we still divide by 13. Then we come up with the value for that. Negative 1.15. And we also come at that point so that we also get that here. Negative 8.23. Then now at this point, you will get, are others getting negative 8.23? Yeah. So now when it comes to this point, expected return was given as 18. So 18 minus negative 8.23. So that negative and the minus will turn to be positive. So that negative and minus will turn to be positive. So it appears 20 what? 26 point. So this one is super efficient or undervalued. It is super efficient or undervalued. It is super efficient or undervalued. Super efficient or undervalued. So that is now our stock B. We also go to stock C. We also check our stock C. So stock C, the correlation with the market is 0.84. We also multiply by that standard deviation is 14. Then we still divide by 13. Zero 0.90. Then when it comes to this area, it is 5. Then also 16.5 minus 5. Then you multiply 0.90. $15.35. Then this one now we also check. Is it 14? 15. What you are given is 15. So it is 15 minus 15 points. So even this one, it is inefficient. Inefficient or overvalued because it is negative. It is inefficient or overvalued. So we also check stock D. So D, when it comes to D, we do the same, whereby we should be required to take negative 0.62. We multiply 18. We also divide by 13. Negative 0.86. .89. So when it comes to this point, so this one was negative 0.86. So now we check what you are given was 13. Negative 4.89. So it turns out to be positive what? 17.89. So even this one, it is super efficient. It is super efficient. So that is for each. But we also need to get the one for the combined. So that is for each. We shall also be required to calculate the one for the combined, so that we make the overall comment. So the one for the combined, for us to get the one for the combined, I will first of all get the total market value. The one for the combined, we need to come up with the total market value. We need to come up with the total market value. So to calculate the total market value, so we get for the combined. So total market value, total, we need to get also the total market value. So to calculate our total market value, you take the number of the shares multiplied by the market price per share. Then we add them together to give us the proportion so that we get the combined. So to combine them, we start with stock A. We start off with stock A. So stock A, the number of the shares are 2 million. Market price per share was given us 30. So we come up with the value. That should be 60 millions. Is it 60 millions? Then for B, they were able to give us how many shares? 1 million. We multiplied by the market price per share is given us 25. That should also give us 25 million. We got the one for C. C, we are given how many shares? So it is 2 million multiplied by the market price per share, which is 20. That should be able to give us which figure? 40. Then also the one for D, which is how many shares? 3 millions. We multiply by. So finally, it will give us a total of 7. So I want you to add them together to give you 200 millions. So once we get that, we want to get the combined beta. We want to get now the combined beta. So to calculate the combined, get the combined beta factor of the portfolio. So to get the combined beta for the portfolio, get the combined beta for the portfolio. I use the proportion for A. You can see the 60 millions. Divide by the total, which is 200 millions. Then the beta for A, on 0.63. Yeah, the beta for A is 0.63. So multiply 0.63. That's now for A. The one for B, you take 25 millions, also divide by the total, which is 200 million. The beta for B is negative 1.15. And for C, you take 40 millions. We also divide by the total, which is 400 millions. You multiply negative 0.90. Then the last one, you take 75 millions. We also divide by 200 millions. So this one we multiply negative 0.86. So that should be able to give you the combined beta for the portfolio. We get the combined beta of the portfolio. That should be able to give you the combined beta factor for the portfolio. So we shall be able to come up with the combined beta factor of the portfolio. Nakuja which fair? 0.97. Like that. No, 0.097. Negative 0.097. 0.097. Yes. Yeah, so once we have done that, we shall also calculate the combined return of the portfolio. So to compute the combined return for the portfolio, we use the security market line, the risk-free rate plus in brackets expected return for the market minus the risk-free rate. But we use the combined beta for the portfolio. We use the combined. So to get a combined return for the portfolio, we use the security market line like that. So you remember the risk-free rate? It was 5. We remember expected return for the market, and it also minus. So this combined beta for the portfolio, we need to calculate, let's say, negative 0.096. You got 3.97. So we get 3.9. So apart from that, I will also calculate the combined expected return of the portfolio. I'm getting 3.88. 3.88. When you round off to 2 decimal places, Eight like that. So that's now our combined return for the portfolio. So we also need to calculate the combined expected return for the portfolio. So for the combined, we use the proportions. So this one will be 60 million divided by 200 million. So multiplied by expected return for A. Remember expected return for A? It was 10 like that. Also this one, we take 25 divided by 200. Expected return for B, it was 18. Then the next one, we also take 40 over 200. So this one we multiply by 15. Then the next one we also take 75 millions divided by 200 millions. This one we multiply by what? 30. We multiply by 30. Then we come up with the value for that. $13.13. So we are netting 13. Then we finally remember that portion. Remember before you make the comment, whereby you take the combined expected return of the portfolio, we minus the combined return of the portfolio. So finally, we now come to that portion whereby you now take 13.13, we minus 3.88. So this is, remember that part, expected return for the portfolio minus the return for the portfolio. So it is giving us positive what? 9.25. So you can see now it is super efficient because it is positive. Yeah. So now I figure that in my schedule, before the comment, it was expected return of the security minus the return for them, but now we have combined. So it is coming to be positive. So when it comes to the comment, because it is positive, it is super efficient. So combined, it is super efficient because this figure is positive. What I've done, it is like I've prepared that schedule. Remember that schedule. Valid the beta factor. One of your portion of beta factor, the beta factor, you have to be part of negative 0.097. Then, kuna pale tunatumia security market line. Remember that. Sasa hiyo ndio hii. Hiyo place ya security market line. Katupea hii return. Then kuna hiyo portion tulikuwa tuna calculate expected return minus the return of the portfolio. Check that portion. Yes, not your column. Yeah, just the value column number. Yes, number Now, nimeanza na column number. The combined, your column 1. One of your stock A, B, C, and D. So size to combine your column number 1. Then column number 2 was the beta factor. So here. So now your beta factor of X. Yes. So now we have calculated the combined beta factor. So that combined beta factor, you to report as 0.097. So remember how we got that. Yes. Then kuna hiyo column nyingine ya kutumia security market line. So it is the return, the risk-free rate, then this minus that. Then now the beta factor should be the one for the combined. You get that question? Yeah. So
what's the rest of the thing? Then we just pick
the beta.
The beta.
Yeah.
Then when you use that beta, you have calculated the combined.
It's the combined return for the portfolio.
So what is making us get the combined? Is it using the combined beta?
The combined beta and also the combined expected return. So nakumbuka hii ilikuwa ya A.
Yes.
Ilikuwa ya B. Yes. Na hiyo ikakuwa ya C. Na hiyo ikakuwa ya B. Sasa nikacombine zote pamoja using the proportion. Ndio ikakupea 13.13.
Okay, up to where we are getting 8.8. Expected return.
Yes.
May request.
Someone else you are asking?
My question is, I wish we can look at the two areas in real life where we have the expected return is what if you invest your funds,
Yeah, you get.
right? So a scenario where the expected return is 10%. That is what you expect.
Yes.
But the market at that time is giving you 12.
Yes.
Is that portfolio efficient or inefficient?
That portfolio is inefficient because you are getting 10, but the market has promised you 12. Yeah, so it is inefficient. It is giving you less returns than the benchmark of the market. Yeah, so that is inefficient. So if it is super efficient, it is giving you more than the market. So I will give you an example of barter trade. You can go to a market, you buy an animal to sell 10,000, a cow. Then you go and sell. So you can either sell at more than 10 or less than 10. So if I sell it at say 12, so that is super efficient for me. I've gotten a higher profit. But if I sell at less than 10, let's say 8, so I've gotten a loss. So it is inefficient transaction. That's basically what we mean. But if it happened to be the same, what I'm buying and what it means it is efficient. There is no profit or loss. So it is basically what we are discussing on the share. You are selling the share. You buy the share in the stock exchange market, then you sell to another person. So you are selling it at this particular one. You see this one? Now sell at 13.13. But in the market, it is going at 3.88. So you will be forced to buy and sell because you get more returns. So what I've done, I started with each separately. Nakumbuka your first element.
Yes.
But now after that, we want to combine all of them together. So combining them, we had been given about the shares and the market price per share. So we use that combination to get the proportion for each, then we add them together. So that's now where we are. I computed for each separately. Some of them were super efficient, others were inefficient. Now we come to the overall. The overall, when you combine them together, it finally becomes to be super efficient. So now the question was, should we change the composition? Or we should not change the composition. So if this one and this are the same, the difference will be 0. So when it is 0, it is efficient or correctly valued. When the difference is 0, then it is efficient or So when it is efficient or correctly valued, you don't do anything because you are not going at a loss, neither you are getting a profit. But if it is super efficient or inefficient, you need to do something, either to buy or to sell. You see, when it is super efficient, just sell because you get a profit. When it is inefficient, don't sell because you get a what? A loss. But now when the two are the same, we just remain there. Yeah, we don't make any decision. That's where we are. So changing the composition is coming up with a new decision, either buying or selling. But now when the two are the same, we don't bother about that. So you see, when you have some shares in a given company, let's say you have shares in Safaricom. If the price goes up, you sell to get the money. When it will go down, you will buy. And then you will retain them in the stock market. So if the buying and the selling price is the same, then you don't do anything. You see what happens in that way. So that's where we are.
But if the price goes down, then you already have the shares, but you don't sell.
No, so you may be having some money elsewhere. You buy and you earn.
You don't have one.
Yes, but that's where we are advising you. That's what we are advising you. If the prices have gone down, because it is not always the money from the sale or buy, you are an investor. So when the share price goes down in the market, you are advised to go and buy because you are buying them at a lower price. But immediately you discover that the prices have gone up, go and do what? And sell. Because in either case, you are getting a profit. And when it goes down, buy today and you sell, let's say a year later, the price will have done what? Will have gone up. So the issue is not the money of that share, is the investment. You want to make an investment. So in our advice for this case, we advise that the investor should change the composition. The investor should change the composition of the portfolio. The investor should change the composition of the portfolio. The investor should change the composition of the portfolio since individual securities are either efficient or inefficient or super efficient. Individual security are either inefficient or super efficient. Individual security are either inefficient or super efficient. Are either inefficient or super efficient. While the overall portfolio is super efficient. While the overall portfolio is super efficient. While the overall portfolio is super efficient. Then we can add there a note or NB. NB is that if the individual security and overall portfolio, if individual security and overall portfolio are efficient, if individual security and overall portfolios are efficient, then the investor should not change the composition. 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 So that is now the advice that you are meant to give. So you compute for each separately, then you make the comment. So that's now on that question. You are ready for the prayers. So you can have a short break for those who are going for the prayers. Then when we come back, after like 5 minutes, we do another question on that.
Nashika hivi chaja. Bado nimechange nini? 2020 questions. Utaniambia vizuri. Ninaombea kila mwanafunzi hapa. Sawa. Are you sure that the consequences?
So we can also check the one for, let us also check the question for December 2013, question number 3, part B. December 2013, question number 3, part B. You can also refer to the question for December 2013, question number 3, part B. So maybe before we go to that one, before we go to that question, let us first check this one for the sitting off. I want us to check first the one for November 2020. We can check the one for November 2020, question number 3, part B. November 2020, question number 3, part B. We can first check the one for November 2020, question number 3, part B. November 2020, question number 3, part B. So let us first check the one for November. November 2020, question number 3, part B. So when it comes to November 2020, question number 3, part B. November 2020, there is a question number 3, part B. So that question 3, part B for November 2020, you are given information that the shareholders of Mali Investment Holdings have for the last 2 years managed to save an accumulated fund of shillings 15 million available for the investment. Available for the investment. So a financial analyst they are hired to appraise some of the possible projects they can invest in has availed the following information. They have availed the following information. So they gave you the information, the project P, Q, R, and S. They have also given you the initial cash outlay. They also gave us expected returns, also the standard deviation. Then the covariance between various project contribution are as follows. So they have given you the project pairing PQ, PR, PS, QR, QS, and also RS. So those are the pairs that we should come up with. So additional information, not number 1. The management is planning to invest by pairing the projects. The management is planning by doing what? Pairing the projects. So the maximum capital that can be invested is the accumulated fund as shown above. You can see what they have shown us above, the 15 million. So when you combine, the maximum should be what? 15 million or less. Then they have said that any paired project is mutually exclusive and none of the project is what? Divisible. So mutually exclusive means they serve the same purpose. Once you pick this one, you automatically reject the other. Once you pick this combination, you automatically reject the other combination. So required for each possible project pairing, for each possible project pairing combination, calculate expected what? Return. Also correlation coefficient and also the standard deviation. Then Roman letter 2, advise the shareholders of the Mali Investment Holding on the optimal project pair based on what? The mean variance. Based on the mean variance. That's the same as the coefficient of variation. We have seen how to get the coefficient of variation at that point. So what we need to do in the question, you want to know the pairing. Which one do we accept and which one do we reject? So when you combine, we must add up to 15 million or less. If it is more than 15 million, that one will be rejected. That one will be rejected. So let us first check accepted project combination. Let us first check the accepted project combination before we calculate the expected. We shall first check the accepted projects combination. So we need to come up with accepted project combination. So accepted. First come up with accepted projects combination. Or simply you can have it just as project combination. Let us just have it as project combination. You can just have it as project combination. So the first project pairing, it is PQ. The first one is PQ. So under PQ, you want to get the total amount. So total amount. So total amount, you can see P is 9 million. You see P is 9 million. Then you can see Q. Q is what? 7 million. So when you add, so this one is rejected. So you indicate it is rejected. So the total amount is how much? 15. So it should either be 15 or less. So that combination is rejected. So we confirm the PR. We confirm PR. So for PR, total amount. So P, it is 9. R is how much? R is 6. So when you add, it will give us which here. So that one you say accepted. So that one accept. That combination, that one we accept. The next pairing is PS. The next one is P. So total amount for PS. Total amount. So this one we take 9 plus what? 9 plus 8. So 9 plus 8. 17. That one is, that one you reject. That one we reject. The next one is supposed to be QR. We also confirm QR. So total amount for QR. So Q, it is how much? 7 million. Then R is how much? So 7 million plus 6 million should give us it. So that one we accept. That one we accept. The next combination is QS. The next one is QS. So QS total amount is meant to be 7 plus what? Plus 8. So 7 plus 8. So that QS will be accepted. QS will be accepted. Then the next one is RS. The next one is RS. So RS, you take 6 plus 8. So that one is what? So that one we accept. So after doing that analysis, now we go to the Roman letter 1, where we start with the first accepted combination. We are now on the Roman letter 1. We start off with the first combination. So the first combination that you have accepted, the first combination that you have accepted is which one? So we start with PR. So we start with PR. So the question required you to calculate expected return, correlation coefficient, and also the standard deviation. So we start with expected return. We start off with expected return. We start off with the expected return. So when we combine the two projects, they become a portfolio. So to compute expected return of that PR, of that particular PR. So we add the two figures together. You see, P was 9 million, R was 6. So you take the 9 million for P, divide by the total. The total 9 plus 6, it gave us which figure? 15. Yeah, so divide by 15. Then multiplied by, you can see expected return for P. Expected return for P is 12. So multiplied by 12. Then you add the proportion for R. You can see the proportion for R. It is 6 million divided by what? 15. What is the expected return for R? It is 16. So you need to compare the expected return for that combination. So you combine them together using the proportions. You combine them together using the proportions. You combine them together using the proportions. 13.6. So that now will give us 13.6. So that is now expected returns. We also compute the standard deviation because they want the expected return, standard deviation, and the correlation. So we got the standard deviation. We also compute the standard deviation. We shall deal with each combination for all of them before we go to another combination. So we now also compute the standard deviation. We also calculate the standard deviation. The standard deviation. So to get the standard deviation of PR, you still do the same. 9 million divided by 15 million. Then we multiply by. So what is the standard deviation for P? Multiply 2.5. Then you also add 6 million divided by 15 million. So what is the standard deviation for R? 2.3. So you add them together. 2.42. So 2.42. Then now we also compute. We also wanted you to calculate the correlation coefficient. We also wanted you to calculate the correlation coefficient. The correlation coefficient. The correlation coefficient. So to compute the correlation coefficient, we use R. So correlation coefficient between P and R. So correlation coefficient is supposed to be given by the covariance between P and R, divided by the standard deviation for P, multiplied by the standard deviation for R. Like that. So to calculate the correlation coefficient, we use R to represent the correlation coefficient. So it will be given by the covariance between P and R, divided by standard deviation of B, multiplied by the standard deviation for R. So covariance. What are we given as the covariance between P and R? So you take the 1.3. Then standard deviation for P. The standard deviation for P it is 2.5. Then the standard deviation for R. What are you given as the standard deviation for R? 2.3. So we get the value for that.
0.23.
So it is positive 0.23. So that is now for the first combination that we accepted. So we got the second combination that we accepted. So the second combination was which one and which one? QR. Yeah, so now we got to the second combination as QR. We got the next combination as QR. We also check the next combination as QR. So the next combination was QR. So we start with expected returns. We start with the expected returns. So expected return for that. So we get the expected return of QR. So Q, it has how much? 7. So we take 7 million, we divide by the total. So you can see R was 6. So 7 plus 6 gives you 13. So you divide by 13 million, multiplied by what we have been given as expected return for Q. So multiplied by 1. So we go to the other one of R. So the one for R is 6 millions divided by the total, which is 13 millions. Then what are we given as the expected return for R? So multiplied by 16 gets the value for that. Yeah, so the next one, we also commute the standard deviation. So we also calculate the standard deviation. So to get the standard deviation for the portfolio, that is QR, the standard deviation of QR, we do the same. Where you take 7 million, divide by 13 millions. So standard deviation for Q, 1.8. Then we do the same for the other one. It is 6 millions, divide by 13. So this one we multiply by us. By 2.3. So after that, we got to number 3. So number three is meant to be the correlation coefficient. Number 3 is meant to be the correlation coefficient. The correlation coefficient. So to get the correlation coefficient, come up with the correlation coefficient. So correlation coefficient. So to get the covariance between R divided by the standard deviation from Q multiplied by the standard deviation for R. So what are you given as the covariance? 1.5. Yeah, so you take 1.5, we divide by. So what are you having there as the standard deviation for Q? 1.8. What is the standard deviation for R? 2.3. So we still have how many combinations remaining? Yeah, so there is the one for QS and RS. So I want you now to try those two. The one for QS and also RS, following the same procedure. Following the same procedure, also do the same for QS and also RS. Do the same QS and also RS. So I hope we are finished. So I want us to check the Roman letter 2. We can now go to the Roman letter 2. So Roman letter 2, they were asking you to advise the shareholders of Mali Investment Holding on the optimal project pair based on what? Mean variance. So I want us to write something brief on the mean variance. So let us write something on that Roman letter 2 about mean variance. So mean variance or coefficient of variation. The mean variance is also known as the coefficient of variation. So andike mean variance or coefficient of variation. Mean variance or coefficient of variation. Mean variance or coefficient of variation. So under that, we summarize that it is the relative measure of the risk. It is the relative measure of the risk. It is the relative measure of the risk. It is the relative measure of the risk, and it indicates the risk by unit of return, and it indicates the risk by unit of return, and it indicates the risk by unit of return. It indicates the risk by unit of return. Then you continue by noting that the lower the coefficient of variation, the lower the coefficient of variation, the less risky the project is. The lower the coefficient of variation, the less risky the project is. The lower the coefficient of variation, the less risky the project is. So we should be ranking them. Then the one that will be having the lowest coefficient of variation, that will be the optimal project combination. That now would be the optimal project combination. That now would be the optimal project combination. So when you want to calculate the coefficient of variation or the mean, so coefficient of variation, it is supposed to be given by the standard deviation divided by expected return. So to get coefficient of variation, it is simply the standard deviation divided by what? Expected return. So we compute for each pair we calculate for each pair. So we start with the first one. The first one was which pair? So coefficient of variation of PR, it is supposed to be given by the standard deviation of PR divided by the expected return of PR. We calculated all of them. In your notes under PR in the Roman letter 1. What was the standard deviation? 2.42. Then here we calculate expected return. Expected return, it was 13.6. So that is now coefficient of variation of the first combination. That now will give you the coefficient of variation of the first combination. So organize a round off into two decimal places. 0.18. So 0.18. We go to the second combination. So the second combination was which one on the So coefficient of variation for QR, you also get the standard deviation of QR, also divided by expected return of QR, like that. Zero point 0.11. Then what was the expected return?
15.69.
Yeah.
Standard deviation 2.03.
2.03. Then 18.69. Okay, inakuja ngapi? 0.11. Then the third combination was QS, whereby we also get the standard deviation for QS, expected return for QS. So what was the standard deviation for QS? 1.69. Expected return 17.27. Sorry? 17 points. What is 17.27 and up to 5? The part to 7. And the last combination was which combination?
RS.
RS. So even this one, you get the standard deviation of RS. Then divide by expected return of RS. So what was the standard deviation for RS? Sorry? 1.9. So you take 1.9, then expected return is what? 14.86. Yeah. So unapata ngapi mkidivide hiyo? 0.13. Na hii ingine ilikuwa 0.1 like that. 0.1. When you round off to two decimal places, 0.10 like that. Yeah, so we pick the lowest coefficient of variation. The lowest is 0.10. Yeah, the one for QS. So now we make a conclusion that the optimal project combination is where the coefficient of variation is minimum. The optimal project combination is where coefficient of variation is minimum. Coefficient of variation is minimum. Therefore, select QS. Therefore, select QS. Therefore, we select QS. We select QS. So that's now what we can get from that question. So we can now stop there for today. When we meet, when we meet tomorrow, we should be able to finish that topic. We shall get some 2 other questions, then we conclude on that. So we can stop there for now.